On July 30th, 2026, the United States national debt reached $39.84 trillion. Yet the dollar did not collapse. Treasury auctions continued, banks opened, markets traded, government payments went out, and investors continued buying American debt. For years, people have predicted that rising debt would trigger an immediate economic collapse. But it has not happened. So, is the number meaningless? No. The United States has built a financial system supported by 4 powerful pillars. These pillars allow the country to refinance debt, distribute financial risk, and delay the consequences for years. But they cannot remove those consequences forever. And the most dangerous number may not be $40 trillion. It may be $1 trillion. We will return to that number shortly. First, the headline needs to be divided. Of the nearly $39.84 trillion in total federal debt, approximately $32.04 trillion was debt held by the public. Another $7.81 trillion was intragovernmental debt. Intragovernmental debt is money one federal account owes another, including obligations held by government trust funds. Debt held by the public is different. It is owned by investors, banks, pension funds, insurance companies, households, foreign governments, financial institutions, and the Federal Reserve. Both categories represent real obligations. But debt held by the public creates the greatest pressure in financial markets because it must be continuously financed by buyers. In 2026, debt held by the public was projected to equal approximately 101% of the entire United States economy. That is close to the previous historic record of 106% reached after the Second World War. The number is enormous. But enormous debt does not automatically produce an immediate collapse. The first support holding the system up is refinancing. A government is not identical to a household. A household has a limited working life and normally must repay its debts from personal income. The federal government is a continuing institution with the power to collect taxes and borrow over long periods. The Treasury issues bills that mature in weeks or months. It issues notes that mature over several years. And it issues bonds that can remain outstanding for decades. The entire national debt does not become payable on one morning. When Treasury securities mature, the government normally sells new securities and uses the proceeds to repay the old ones. This is called refinancing. The debt is not eliminated, it is rolled forward. The system continues as long as investors remain willing to lend to the United States at manageable interest rates. But America is not only refinancing old debt, it is also borrowing more money every year. For 2026, federal revenue was projected at approximately $5.6 trillion. Federal spending was projected at about $7.4 trillion. That created a deficit of roughly $1.9 trillion. The government had to borrow the difference. The second support is international demand for the United States dollar. Oil helped strengthen global demand for dollars during the petrodollar era. But the petrodollar is only one part of a much larger financial system. Dollars are used in international trade, global banking, central bank reserves, foreign loans, bond markets, commodity pricing, and cross-border payments. At the end of 2025, the dollar represented approximately 56.77% of allocated global foreign exchange reserves. The euro represented about 20.25%. China's renminbi represented only around 1.95%. The dollar was also involved in approximately 88% of global foreign exchange transactions. Around 55% of international and foreign currency banking claims were denominated in dollars, and the dollar accounted for roughly 60% of foreign currency debt issuance. This creates constant structural demand for dollar assets, and one of the largest places to store those dollars is the United States Treasury market. Foreign investors held approximately $9 trillion in Treasury securities, or around 32% of marketable Treasury debt. Private domestic investors held roughly 55%. The Federal Reserve held approximately 13%. The third support is the scale and liquidity of the Treasury market itself. By June 2026, approximately $31.1 trillion in Treasury securities was outstanding. More importantly, around $1.23 trillion traded on an average day. The fourth support is the Federal Reserve. The Federal Reserve cannot make government debt disappear, but it can provide dollar liquidity and purchase Treasury securities in the secondary market when the financial system begins to freeze. There are 4 important gauges. Gauge 1 is interest costs. How much government revenue is being consumed before new programs or investments can be funded? Gauge 2 is Treasury yields. Are investors demanding significantly higher interest rates before they agree to lend? Gauge 3 is inflation and the dollar. Is inflation remaining elevated while international demand for dollars begins to weaken? Gauge 4 is economic growth. Is the economy growing fast enough to keep pace with government debt? From 2026 through 2036, federal deficits were projected to remain at or above approximately 5.6% of gross domestic product every year. Debt held by the public was projected to rise from around 101% of gross domestic product in 2026 to approximately 120% by 2036. That would be the highest level in American history. So why has the United States not collapsed under nearly $40 trillion of debt? Because it has a huge economy and tax base, because it borrows in its own currency, because its debt matures gradually rather than all at once, because the dollar remains central to global finance, because the Treasury market is exceptionally large and liquid, and because the Federal Reserve can stabilize the financial system during a panic. But these supports do not make the debt harmless. They transform an immediate collapse into rising interest costs, higher borrowing expenses, political pressure, weaker public investment, and fewer choices during the next crisis. The real question is not on what date will America go bankrupt. The real question is how much of America's future income will be spent paying for promises made in the past. At nearly $40 trillion, the clock has not reached zero, but it is running faster.